GM. GM. Monday, 29th of January. Daily levels. So we've had our weekly close. Looking very good. Pretty solid. Didn't close up near the highs, but overall a great reversal on last week. And typically, that type of weekly candle, that sort of reversal, would indicate some kind of upwards pressure on price. I wouldn't be surprised to see something like this even. We had this reversal candle and then a bit of chop but upwards. And that was of course after we went below the bands. It's even stronger, we've held the bands. I would say BTC probably, forget fresh chart, probably looking at it to stay within this range here. It could come down as low as the bands, up as high as about 45, 46. And I would expect selling at that point. I wouldn't be surprised to see this, right? Where whether it goes up or down first, and by the way, I think it goes up first. I'm still long. But I wouldn't be surprised to see price coming back as low as these levels and into the weekly bands. So even if you go up first, you might see it sweep out that liquidity at 38.5. Sorry, 38.5? 43.5. Then down as far as here. Then up. And then back down. So there's two different paths to get to the same place. Up and down, down and up. I do think we come up and fill into this gap. That's the most likely place where spot sellers will step back in. But overall, Bitcoin's looking good. And what you're just looking for now is how much higher do we go? And then do we form higher lows? If we start to form higher lows within this range, it's very likely then that it's going to be building for a next breakout. We've had the sell-off. So, you know, when you go back and you look at these kind of bull market moves, and whenever you're in mid-bull, you see these type of movements. So you have your sell-off, right? And then price just chops around within this range for a couple of months. You have your big sell-off here, right, where we sold off from the top, flushed out, price sideways, chopping, grinding higher. And that's very typical. Even here, you had your first sell-off, second, chopping, grinding, boom. And then, by the way, Tesla announced they bought Bitcoin here. I am fully expecting this year another big entity, multiple entities, to announce that they've bought Bitcoin. That could be sovereign wealth funds, could be some of the biggest companies in the world, your Saudi, Aramco's, Apple's, some of the biggest single investors or businessmen or entrepreneurs in the world, your Jeff Bezos, etc. Because it now becomes, especially with the addition of, you know, BlackRock, Larry Fink backing it, it now becomes a race to see who gets in next. Whether they buy a lot or a little, I don't know. But we haven't seen the last of the major countries and companies and individuals investing into Bitcoin. So that's interesting. I think we're going to see that. Not just like last cycle, all we got was Tesla, really. I think this cycle we get just a wave. A lot of that, you know, could even potentially go in through the ETF, but the net result is the exact same. Because it's a spot ETF, it doesn't matter if they buy through the ETF or buy their own Bitcoin personally. The net result is the same. And I think that's going to have positive upwards pressure on price. And also then we go back to here, I think that's it. That's the bottom. Why would that not be the bottom? Why, when in every bull market move we have, the bottom comes after the first sell-off typically, right? Like any of these 2021s I showed. You sell off and then you go sideways, you sell off, then you go sideways. Why would we not just go sideways now? Why wouldn't price just grind around in here? Why wouldn't it go up and down and up and down and then go higher? Right? That's mostly what I'm expecting. As much as we can go lower, It's surely possible. I don't know, this weekly reversal tells me otherwise. We can fill this wick in for sure. Price can come back down. It could even maybe touch the bottom and take the wick out. But I think this 39.49 is setting up to form a base. You know, a lot of people were talking about, oh, this is just like the previous ETF launch, but it's not. Right? Previous ETF launch, we launched, red week, red week, red week. This one, we launched, red week, sideways week, reversal week. So it's not the same. Same as over here. Coinbase went on the NASDAQ, red week, complacency bounce, 0. We had red week, sideways week, reversal week. So you could see what complacency bounce in here if we have a strong move up this week. This is also the other thing. The stronger the move this week, the more likely it is that we actually go lower, right? Because if Bitcoin rips higher up here, and then, well, maybe not even that far, but rips higher up into a lower high like this, that really does put it at risk of going to new lows. Because the push up to there so fast probably indicates too aggressive FOMO buying, where we've had no decent pullback, and it could easily go down to a new low, because that's how a downtrend goes, right? But if you see like a shallow bounce and a pullback, that's more like a consolidation forming. So anyway, there's a bunch of different ways it can go, but overall, of course, I'm bullish. Nothing's changed from that perspective. On the data, nothing much happening. Bitcoin funding is finally back to neutral, indicating a bit of health coming back into the market. Maybe a little bit of speculation, which a little bit is good. We need it. We need positive sentiment. We need bullish sentiment. We don't want euphoria. We don't want overextension. We don't want over leverage. Altcoins have ticked up a little bit, but mostly they're okay. I think pullback is probably the best. You know, if we push higher, a pullback is probably in order. But if you look at the funding rates and the open interest for alts and Bitcoin, put that down, put this up. So funding rate on BTC, as we've seen, is right around neutral, slightly below neutral. Funding on alts, still below neutral. And there we have it. So, nothing crazy. Alt funding below neutral, Bitcoin funding below neutral. Open interest just in our reaccumulation process, especially for alts. Reaccumulation looking pretty good here. Steadily rising funding. Steadily rising OI. After our bigger leverage flushes from a few weeks ago. And if you look at alts here, the alts as a whole have actually put in a really clear accumulation sign. The altcoin market, if we go back here to since the 8th of January to now, so the 8th to the 23rd, if you look at total 3. So the 8th was this big flush. This second push. This is when alts got nuked, right? That was when open interest bottomed out. We pushed lower, but open interest didn't on the 23rd. Price pushed lower, OI didn't. So see it here on a 4-hour chart. We'll just zoom into alts. This is quite healthy. We're seeing open interest rising and continuing to hold, but it's not like ramping up like this. It's not pushing up to new highs. It's not like overly speculation. This is low funding rate, open interest divergence positive. OI makes higher lows, price made lower lows in here. That's good. That's a sign of accumulation. That's a sign of healthy reaccumulation. You don't want to see open interest keep bleeding. The whole point is in a bull market, you have the leverage flush, right? Then we bottom out. But you don't want to see it steadily decline then. If it keeps declining after that, that's a sign of just lack of interest. People leaving the market. We're not seeing that. We're actually seeing the opposite. We're seeing some early signs of accumulation on alts, which is good. Spot premium is back as well. We've had a couple of examples. If you just look at Bitcoin, for example, the spot, so for the longest time there, we had huge disparities in the spot and futures prices. Or if you compare Bitcoin on Coinbase and Binance, I put them on new price scale, yeah, and then you compare the perps. Let's do Bybit, let's do CME, and let's do Binance, the perps. So I need to get the labels on these. There we go. So you can see here that you've got Bitcoin, Coinbase, Bitcoin on Binance and Bybit. So 42,216, 42,210, 42,214. That's Coinbase on the left, and then the two derivatives on the right. So the derivatives, the perps price is lower. Is lower than the spot price. That means spot is trading at a premium. It's ever so slight. It's more like back to neutral, but that's really good. You go to Binance on the left, 42,233. So it's even higher. So Coinbase spot price, Binance spot price are higher than the perpetual futures price, which is good. Very healthy. Very healthy overall for the market, as we see. You know, when you go back into some of these areas over here, like, where can we find some examples? Like, even, let's say, at the peak of this move here, we had pretty significant 280, 308, 296 with 273. So you flip back to December, the perps on average were generally leading the spot price. And whenever the perps are leading the spot price, it shows a perp premium, a premium on futures, which indicates that the market's being driven more by leverage, or at least not by spot. But we now have the opposite. So when you're looking for a bottom, these are all the signs you look for. You see healthy wipeout of funding, or healthy reset of funding, I should say, healthy wipeout of open interest, and then open interest starts to reaccumulate, like we've seen on alts. You see the perp and spot premium return back to positive for spot. And then, of course, we have sentiment, which is fucking toxic and terrible, which is great. And we have people de-risking and they're out of the market and they're sidelined. So until we see, like, I think that will all change pretty quickly. Like, if Bitcoin rips up to here, people will start to ape back in because they feel like they've missed the bottom, and that's when they're probably at risk of a flush back down to 40, and then away we go again. So, you know, if I'm looking at it from this perspective, we've had one leg, right? We had our bounce off the lows into a consolidation. One leg up, consolidate. I expect another leg up, consolidate. Probably a final leg, and then we retrace. Back down, and then away we go. Like, that would be my most probable path, is this, and all I care about after that is, does a higher low form? If it does, then I would say bottom's in, and it's just like 2020 or any of these other times where you go back, you look at the market in here, right? You had your flush out, you had your run up, everyone got excited, back down, but it made a higher low. Pushed up again, made a new high, came back, made a higher low. To me, that's all that really matters. Flush out. Low, higher low. Higher high, higher low. New highs, and away we go. Price predictions, targets, all that, doesn't really matter to me. That's why we stay predominantly spot long. For my long trade, I did start adding again, but I'll talk about that in trade of the day. Now, today we have the QRA, which I talked about yesterday on Weekly Outlook, so you can check Weekly Outlook for that. But here's a good post by a guy called Miad talking about the importance of QRA. Today we'll get an idea of how much Treasury will likely borrow for the coming quarter. On Wednesday, we'll know the exact composition, i.e. more bills or more bonds. So today, we're going to find out the rough guideline. Wednesday, we're going to find out what instruments they're going to do that through. And also on Wednesday, we've got the Federal Funds Rate decision, the FOMC meeting, and Powell's speech. So big week of the whole macro liquidity shit. But he's saying either way, massive moves for gold coming, because gold is extremely sensitive to all these changes. And as we know, gold and Bitcoin are very tightly correlated at the moment. So, if bond issuance increases and real yields move north, expect this scenario where gold will essentially nuke. That's important. That's one potential outcome. So, brush up on what this means and look out for it today and Wednesday. On the other hand, if real yields move lower again, gold will go for 2100. Simple as that, we have a breakout. And it is really that simple. Gold and Bitcoin, as an extension, are waiting on this. The reason for that is because real yields especially, real yields are the actual return you can get on your cash. Right? Gold and Bitcoin are not yield-bearing assets. They don't produce any returns. They don't produce, any dividend. They don't produce any yield. The returns you get on gold and Bitcoin are just from price appreciation. So, with Treasury and Fed actions, you can get changes in what the real yield is, which is the interest rate less inflation. And if interest rates are 5.5%, and inflation is 3%, you get a positive real yield. There's also other ways you can estimate. Many people estimate yields in different ways. Some people use GDP as well. You can include GDP because if GDP is whatever, like say, if interest rates are 5%, GDP is 5% or 6% in a year, you have to also factor that in because you have to overcome the 5% you could get from the Fed and the 5% productive output from the economy. If the GDP, in a really simple sense, if the GDP of the US is growing 5% a year, that means you need to make more than 5% a year just to keep up. Because GDP is the gross domestic product. That's the total output of the US economy. If that's up 5%, you can be absolutely certain that the stock market will be up at least 5%. Because the stock market is all the biggest companies. And so if GDP is 5%, the stocks are going to be up. Those companies are going to make at least that, if not more, because they're the ones producing the majority of the output. Plus, you then have all the debt issuance and the fucking fiscal spending and all of that juices the GDP even further. All that means is you have to get higher returns in order to just run at par. Whereas if those levels drop, and if we see a drop-off in especially the real yields, it makes gold and Bitcoin more attractive because cash is less attractive. If you had, let's say the Fed cut the rates to 4% and inflation was staying at 3%, you would only have a 1% real yield. You'd only have 1% returns. Because you get 4% for giving your dollars, putting your dollars in money market fund, but 3% of that's wiped due to inflation. And so then investors say, is it really worth putting my money into an MMF just for 1%? It's not. That's where they then go and look for other speculative or defensive or whatever types of assets, including gold. And gold's very sensitive to monetary policy, as is Bitcoin, and fiscal policy. So the more printing, the more liquidity injection from not just the Fed and the US Treasury, but all central banks and all governments has a big impact. So gold is currently, like he says in his Twitter thread, gold is definitely at this inflection point where it can go down very easily and it can go up and break out very easily. Whichever path it takes, you're going to see a super strong effect on BTC as a result. There's an inside month forming, so you know what an inside candle is? December's candle. We spent all of January compressing tight inside of December's candle. And that inside month has formed between December's high and December's low. And then when you zoom in, you can see that within this, we've got January's low and January's high, the dotted red lines, and I've got the indicators or the alerts set on each of them. Whichever way this breaks will be very interesting. The most important break is December's low and December's high, but also January's low and January's high will be important as well, because we're only 2 days away from the end of the month, right? We've got today, tomorrow, and Wednesday, so just under 3 days, between 2-3 days left. That's going to be a big one. And if basically, in a very simple sense, gold up, Bitcoin up, gold down, Bitcoin down, all else being equal, that's how it'll go, right? It's not exactly, obviously, the gold chart doesn't look exactly like the Bitcoin chart, but you can be sure that that's going to be the best case and the way it'll look. Because what happened to gold from October all the way into December? Big rally. What did Bitcoin do? Big rally. Oh, it was the ETF. Was it? Was it the ETF? Or was it the ETF plus the fact that positive gold flows and positive gold appreciation helped BTC to rise? It's both, right? The whole world, the whole macro is just one big trade. It's all one interrelated organism. So you got gold. You've also got silver, which is just, I mean, if this breaks to the upside, it's fucking insane. Because silver has been, if you actually go to a quarterly chart, so it's a 3-month chart, silver peaked out in 2011, all the way down into 2015 and a double bottom of 2020 and COVID. Broke out from that level, up into the highs 2021, back down, so flipped that, so resistance into support, held it. So that's a 3-month basis. Flipped down to a monthly with this diagonal trend line breakout. I think I actually have that marked on a weekly. Where do I have it marked? Maybe it was on the... Anyway, even regardless of how you draw it, it's just a trend line. But you can see clearly it's broken out of it, consolidating outside of it. Silver will follow gold broadly. They're not the exact same, but they are obviously historically pretty well correlated. And if we see this positive, trade for anything that is not fiat, so it's an anti-fiat trade, which includes gold, silver, Bitcoin, you'll see price move up, and that will also be a positive for crypto market. So these are going to be sensitive to what happens this week. Stock market as well will of course be sensitive to what happens this week, because Yellen's going to tell you what she's doing with debt this year. Then Powell's going to indicate what they're doing with monetary policy this year. Yellen's going to say, how are we going to fund our massive fiscal deficits? How are we going to pay our fucking $34 trillion debt? And so I think with stocks, to me, the most likely outcome is probably more upside first, and then a pretty decent pullback. So like probably another maybe month or two of upside, and then a pullback into this area, and then probably a reacceleration to highs. And then if things get bad, which I think will be next year, personally, I could see us coming down and attacking these lows, and then continuing the march that stocks do, just up only. I do think this level can get tagged at some point, but I don't think it's before we go higher, and before we form a higher low, because look, it's low, high, higher low, higher high, higher low. We'll form a higher high, we'll probably form a higher low, because the next big dip will get bought. This is the thing. I think a lot of people are really mid-curving this. The doomers are always going to be doomers. The stock market is fucking bullish. Wealthy people, their portfolios are all-time highs. The outlook is strong. People are saying that the debt's unsustainable. The earnings don't match. The price to earnings ratios are crazy. The valuations in the stock market are insane. No. The more they debase the currency, the more the stock market will go up. It's simple. The more liquidity, the more money they flow in, the more stocks will go up. This happens especially so the worse the currency gets. So the more dollars they print, the worse this will get, and the better it will be for stocks. But it's not better, right? Because when you actually divide the S&P by the money supply, USM2, it's not even keeping pace. So when you look at it just raw, it looks great. When you look at it like this, Doesn't look so great, does it? This is when you account for the money printing. So the amount of money they actually printed since 2000 net has way outstripped the actual price of the S&P. So if you bought the S&P in 2000, you're not actually even back at relative highs yet. But by owning the stock market, you have outperformed the average person. So your purchasing power has been preserved in that sense. The average person who doesn't own stocks, and they were making $2,000 a month in 2000, they're probably making $2,500 a month now. But every consumable, every travel, goods, everything is like 3 times as much since 2000. A fucking McDonald's hamburger, I saw this, and maybe you burgers can confirm. A McDonald's hamburger in the US is basically $3, I think. Just a hamburger. That was always $1 when I was a kid. That was always $1 20 years ago, right? And like that's real inflation. Like, because a McDonald's hamburger, that's what every person eats, right? Not every person, it's up to your own choices, but you know what I mean. It's not like a luxury good. That's a fucking everyday consumable for many people. So since 2000, let's say, has your salary increased 3 times? Most people's hasn't. But the cost of a fucking burger has. Like, that's the reality. So people saying the stock market's overbought, it's not. Look at this. It's just not. It's not. It's fucking not. And you can see that with plenty of room to the upside, people will look at these charts and, put it on a monthly and look at it like this, and it looks scary, right? Oh, look, it's going to crash. Like, what do you mean it's going to crash? Log chart. Long-term chart should be on log. There's the log chart. Right? Not crazy. Just rising. Because it should rise. Because GDP keeps rising. The economy keeps expanding. We've been in a pretty much uninterrupted expansion since 2009. And that will end at some point. But it's a decision by the policymakers to let it happen. And they haven't made any indication that that's going to happen yet. So, today, Yellen. Wednesday, Powell. Gold up, Bitcoin good. Gold down, Bitcoin bad. And then, like this thread says, real yields moving lower is what we want to see as bulls. Bond issuance increase. An increase in real yields. Not what we want to see. So we'll see that coming in. Alright? GM, see you later on the live stream.